Hello and welcome to this webinar on the general presentation project, everyone. This is a joint event by the EFRAG, IASB, Norske Finansanalytikeres Forening and Norsk RegnskapsStiftelse. As you can see on the agenda, we will cover some key aspects of the proposal today, but we will by no means be able to cover all of it. The persons you will be hearing from today is from the IASB, the board member Françoise Flores, and from the IASB staff, Aida Vatrenjak. And from EFRAG, we will hear from Chiara and Prete, the EFRAG TEG Chairwoman, and also from Erlend Kvaal, a board member who is also a previous chair of our NRS committee on IASB or IFRS matters. From other panelists, we have Morten Haukaas, who is also an NRS member and chief accountant of Equinor, the Norwegian oil major, and also Teodor Sveen-Nilsen, an analyst at SpareBank 1, and a member of NFF's group on financial reporting. With me today to manage questions and other aspects of the event is Kjell Røsok from also NFF and financial reporting. An associate professor at Norwegian School of Economics. Through this event, we will be using the Slido app. So I hope you can see on the screen now the instructions for how to enter into the Slido app, and that you have all logged on to the app and responded to the first polling question, which is both to have a better understanding of who's on the line today, and also for us to see that everybody has been able to log on and to get access to the tool. I should also say that in the Slido tool, we have a Q&A session where you can ask questions to the panel through this session. And you can also press like on questions already posted so that we can see if there are others interested in one of those questions. That helps us managing which questions to take first and prioritize. We will also ask you to address the questions that you put in to one of the panelists or organizations presenting, so that we can easier manage the interaction with you. So can we see the slides, or the polling on Slido? I'm afraid I don't see anything on my screen, so I'm a little bit lost here on what we're seeing. You can see that we have at least quite a few participants who have been signing in and responding to the first question on who you are and who you're representing. With that going on in the background, I think we can hand over to Françoise Flores from the IASB, who will present the project as such, and give us some background and the main purpose with this project. I should also, before I do that, say that This session will be recorded and will be possible to view on the EFRAG webpage and also on YouTube after the event. So with that, I hand it over to you, Françoise. Good if you can take us through the main aspects here. Thank you.
Thank you very much for this introduction, and also for the invitation of having the IASB joining with our EFRAG and Norwegian friends in this webinar. I'm happy to share the floor today on this project with Aida Vatrenjak, who's been, in fact, a very successful lead technical staff on the project, and will share the presentation with me. So in words of introduction, I think I should say that this project was decided by the board as part of its Better Communication initiative after the agenda consultation of 2015. The financial presentation aspect of this Better Communication initiative is a very important project responding to very strong calls for having improvements to the presentation of financial statements. We may remember, the decision was made to launch this project. Its scope was defined in 2016, and the exposure draft that we are discussing, the main aspects today, has been published in December last year. Originally, we had granted a full 6 months period for the consultation, and we've extended that until the 30th of September due to the COVID-19 pandemic, so that stakeholders could have all possibilities to fully participate. On the next slide, you will see that the outcome of this project, so on the next slide, will, in terms of how it will materialize, it would materialize in our requirements, would lead to withdrawing the current IS1. Part of that current IS1 would be replaced by a new IFRS standard that includes the new presentation and disclosure requirements, and also a number of requirements which are brought forward from IS1, and a number of sections of current IS1 would be moved to IS 8 and IFRS 7, where we thought that they would better belong. And we have also a number of amendments to IS 7, importantly, because that's where the statement of cash flows requirements are set, and also a number of related issues with associates and JVs, earnings per share, and interim reporting. So how did we move into deliberations and the scope of this project? On the next slide, you will see the main key proposals that we have set in this ED. And really, the approach of the board in this project has been to target very important improvements, so to really identify where improvement was needed. You may remember a project 10 years ago that had undertaken to look at the issue comprehensively, starting from scratch, and that was not successful. And there is a clear call from our constituents that we address issues where really improvement has been identified as needed. So we have had a lot of outreach with users and investors in particular, and identified, as I said, areas of improvement. Really, if I was to summarize this project, I would say that it's really about improving transparency and comparability for those who use the financial statements in practice. So the first call was for a greater comparability, and more particularly in the performance statement, in the income statement, as well as in the cash flow statements. And that's basically the first and the fourth improvement that you can see on the slide. In terms of the structure and contents of statements of profit or loss, the response is in fact to introduce defined subtotals that are not required today, not defined today, and will set in fact intermediate basis for comparisons, and that will be fully introduced by Aida in the next session. In terms of the cash flow statements, comparability is also sought there. And it's basically in the removal of options that the improvement is achieved. But that's not only about comparability, it's also about a greater transparency. Users have told us that they didn't always get the level of granularity that they needed with information that is material to them. And they keep complaining also that eventually there is too much irrelevant information. So we have decided to strengthen the requirements for disaggregating information. And when I say disaggregating, that's disaggregating what needs to be disaggregated and keeping aggregated where the detail is not material. And another very important help to users in terms of transparency to be seen from a worldwide basis is to ensure that non-GAAP measures of performance which are deemed useful by users are presented in the single note to the financial statements, where they would be easy to retrieve, and where they would be fully explained and reconciled. So these are the key proposals in CCD, and we are going to go through a number of them in the following sessions. Thank you.
I'd like to hear some comments from EFRAG to this project, and I will ask Chiara to share some views with us.
Good morning, everyone. EFRAG is pleased to have organized this webinar together with the Norwegian stakeholders, Society of Financial Analysts and Accounting Standard Board, and with the IASB, of course. This is the fourth seminar in a row on PFS. Similarly to what happens for the IASB, also for EFRAG, this has been a long-lasting project and very important in our work plan. We've done a lot of preparatory work, and the cooperation with the IASB has been always very fruitful. In 2019, we ran a desktop analysis, which results are in our draft comment letter, and helped us to identify the expected ex-ante implications of the proposals. We are overall very, very supportive of the direction of the IASB and the key topics where they are developing new proposals. But we have also strongly debated in the technical expert group some of these proposals. That's why our letter also includes supplementary questions on a few topics where we still don't take a position, but we really would like to hear from constituents before forming a view. We have issued our comment letter in February, and it's open for comment until the 28th of September. We are also running a field test jointly with the national standard setters and with the IASB. You have time until the end of July to still, if you are a preparer, propose to participate to this field test. In the next slide, just few words in terms of the overall content of our draft comment letter. As I said, very positive for the potential really to improve the better communication on performance reporting. But at the same time, we identify a series of concerns and remarks, which we hope will help to enhance the operability and the final impact of these proposals. I've put in this slide just few words on items that are not covered in the detail in the remaining of the presentation, including the fact that the IASB has not defined the EBIT and EBITDA, while they are very frequently used. And also, we regret that the amendments to OCI are very limited, basically only to labelling, and we still miss an overall discussion on the role of recycling and OCI. Similarly, also there is still room for future improvement on the statement of changes in equity, and also, but this we will also say later on a more deep discussion about the statement of cash flow. So these are more remarks either to improve the proposals in the ED or to shape the future agenda on the other topics. This is all in terms of introduction from my side.
Chiara. We will then move into the first topic we have on our agenda, the income statement and the operating, investing and financing categories. To take us through the proposal, we have Aida, who will lead us through the proposed changes. In the interest of time, we have chosen not to go deeply into the issues specific to providing financing, not because they're not important, they are, but because we have so many other aspects that we would like to focus on today. So Aida, I hope you can give us a flavor for what this is and what may change for us.
Certainly, Karina. Thank you very much, and good morning, everyone. And I got your instructions, Karina, not to talk too much about banks, so I will just mention maybe a sentence or two, just so not to mislead our participants today that proposals would apply in exactly the same way. So let's look at what the IASB is proposing for the new subtotals and the statement of profit or loss. So we find it's easiest to explain the proposals using examples. So we have an example here on the slide, and I just want to give you a bit of health warning about the example. Whilst the shaded subtotals would be required for all companies, the line items that you see here are illustrative line items, and it doesn't mean that those line items would be required. And the example that we have in front of us shows a company that presents analysis of expenses using by nature method. I will talk a little bit more about two different methods and the proposals around that. So what is the board proposing? So you see here we have 4 categories in the boxes on the right-hand side of the slide, and the proposal is to require entities to classify all income and expenses above profit before tax in one of these 4 categories in the statement of profit or loss. So just also to let you know that this means that income taxes and discontinued operations, which are existing categories in IS1, would not be affected by these proposals, and also these proposals wouldn't affect any recognition or measurement. So let's look at a little bit at each of these categories, and maybe let's start with the operating profit and the operating category. So as you all know, operating profit is very commonly used subtotal today. It is actually so common that when we speak to analysts and other users of financial statements, they often express surprise that it is not already defined. They think it's defined, but it's actually not a defined subtotal today, meaning that companies use their own definitions. And in our own research, we looked at 63 companies using operating profit. We found at least 9 different definitions of this subtotal used in practice today. So what the board is proposing with the operating profit, so we have 2 things. One is underlying objective, which is to capture income and expenses from entities' main business activities. Excuse me. But this is not how operating category is defined. So operating category is defined as a default category, meaning that we have definitions of the income and expenses that will go into the other 3 categories. And then anything that does not meet those definitions and is not income tax or discontinued operations would then by default be classified as operating and would go into this operating category, be part of calculation of the operating profit. And the board thought this approach was helpful because it would help achieve consistent or more consistent application of what goes into the operating category. And it also was consistent with the view by default entities' activities are operating. Also, this approach would avoid having to create some other category where things that wouldn't meet the definitions of existing categories would go in, which clearly would not help consistent application. So this is operating category. So let's look now at the bottom of the slide here on the financing category. So above that, we have a profit before financing, and income tax is subtotal. And the objective of this is to enable users to compare performance of different companies regardless of how they are financed, whether it's debt, equity, what kind of mix. So as you might expect, what is most commonly expected item in this category is interest on debt by companies, which is included here in the line item that you see described as expenses from financing activities. Just to note, there's a couple of more items in this category. One is you can't see on the example here. We assumed it's immaterial in this case, and this is income and expenses from cash and cash equivalents. So this is the only income on assets that would go into the financing category. Otherwise, financing category is all about income and expenses from liabilities. And then the final type of item in this category is the interest on liabilities that do not arise from financing activities, so other your non-financial liabilities, so things like decommissioning provisions. So an example here, we have unwinding of discount here is combined on pension liabilities and provisions that would be here. So this has been a little bit controversial in a sense that there is no clear consensus on where this would be classified, but the board took a view on the basis of most users telling us that they would still consider this together with the financing costs, and therefore the proposal is to classify it in the financing category rather than, give entities some kind of choice or put it in the operating. So with that, let's look at the investing category here around the middle. So the purpose of this category is really to separate returns on the assets that arise quite independently from entities' main business activities. So again, in this example, which is what we call general corporate, the things you would expect to find here are various income and expenses from financial instruments or any returns from investment properties. And just bear in mind, again, this is general corporate, so it would look a little bit different for financial companies such as banks and insurers. And then finally, we have this category of integral associate and joint ventures, which is between operating and investing. And this really came about as a result of board's discussion of where to classify share of profit from equity method of accounting. And there was a bit of balancing needed here, because on one hand, we had a strong demand from users to not classify any results from equity method in the operating category, because as you know, equity method is, presents just a net number in the P&L, which is after tax, which is after finance costs. And the user's margin analysis would be quite disrupted if this was included in the operating, because there's no equivalent revenue number for the associate and joint ventures included. On the other hand, lots of companies have told us that they have associate and joint ventures that are closely related or integral to their main business activities, and they would like to present them, if not within operating, then very close to the operating. So this proposal is the balancing that it requires companies to distinguish between associate and joint ventures that are closely related to main business activities that are integral and therefore don't meet definition of income and expense from investments, and present them separately adjacent to operating profits. And then we have another subtotal here in the middle before we come to the investing category. And then by default, the non-integral share of profit or loss from non-integral associate and joint ventures is investing, because it meets definition of income and expenses from investments. So this has been a little bit controversial proposal as well, in that we hear feedback about concerns about application, and I think we will hear some more about this from the panelists as well. So this is really the categories. I'm just going to mention briefly that, this proposal in general applies to financial institutions, but there are some tweaks that the board has proposed for them to ensure that, remember, the objective of the operating category is to capture income and expense from main business activities. And in order to meet this objective, the bank can't have its interest expense in the financing. It needs to be in the operating. Investment company can't have income from investments in the investing category. It needs to be in the operating. So we have some principles based on these business activities that require then companies such as banks, insurers, investment companies to move items up from investing and or financing categories into operating to meet this objective. And I think for those companies, generally, the proposals would enable them to continue practice that's similar to what they do today. So before I finish this part, I'm just going to go to the next slide a little bit and talk about related topic on the presentation, proposals relating to the presentation. And this really is about analysis of operating expenses. And just as a reminder, what companies do today is they provide analysis of expenses using two methods, what we call by nature or by function. So by nature is analysis where you identify the inputs used, so staff, depreciation, and so on. By function is where you allocate those inputs to functions within the business, for example, research and development, cost and sales, and similar. So what the proposal here is really not that different, but it is a strength there in IS1 today. I think this has been in response to the feedback we have heard from users that they find presentation today sometimes confusing, in that companies can mix two methods and, for example, would present perhaps cost of sales and then have a presentation of separate line item for depreciation, and then users tell us they actually don't know then, does this mean the cost of sales includes part of depreciation and then depreciation line item is not complete, or does it mean that all of depreciation is presented separately, which means cost of sales is then understated and not comparable with cost of sales presented by companies which do not have a separate presentation of depreciation. So to address this concern, the board has made it clear that entities shall not mix the two methods, and the only instance of mixing is when entities present expenses by function and then also present minimum line items which are required already today today, and which are generally by nature items, because understanding is that it's clear to users that those are required line items and they're always separated out by all companies. And I think adjacent to this, there's another aspect of the proposal. So the companies can't mix, and they have to present a method which is most useful in their circumstances, and we have some guidance proposed to help them determine that. And then there is another twist to this, in that users have told us that regardless of which method is most useful for a particular company, users find analysis of expenses by nature of inputs useful in all circumstances, because it helps them forecast future cash flows for the company. And for that reason, the board is proposing that all companies, and therefore even those including that present analysis of expenses by function, would be required to present this analysis by nature. So what this means, what you see here on the right-hand side of the slide, is that the companies that present by function would have a separate note disclosure where they would list analysis of their total operating expenses by nature of inputs used. This is a little bit controversial as well, because I think some companies are concerned about the costs of this exercise, that companies that don't do this today. So this is another one of the areas that we are exploring and trying to understand more through the fieldwork exercise we are doing together with EFRAG. So this concludes my summary of proposals for subtotals and analysis of expenses.
Thank you very much, Aida. It was really good to get an overview and to hear about these very key aspects of the proposal. I will then turn to Erlend and ask for some comments from EFRAG to this part of the proposal. Please, Erlend.
Thank you, Karina. I am Erlend Kvaal. I'm an accounting professor at business school here in Oslo, but here I am as a representative of EFRAG. I was appointed to EFRAG TEG from January 1st of this year, and this project actually was the first that I met. So it was a starting point for me. I will actually repeat some of the things that Aida took up, because I think that some of the issues that Aida mentioned that the board had encountered as difficult questions, we also met in EFRAG TEG. So, but that is also important for constituents to be aware of those items. So I don't think it hurts to hear it again, maybe with a different flavor. But on the general, as a general observation, we, as also Chiara said, we are very much aligned with the IASB. We think that the IASB has done a good job both in scaling this project and finding solutions, and that also comes to the question of income statement, where they apparently find a new radical way of presenting the income statement, but it is not so radical after all, because we can recognize these items and this format, the division between the operating and investing and financing category. And also we had some discussions of whether is it smart to have the most important category operating as a residual, then defining the investing and the financing. But I think we found that actually may work well. So we are comfortable with that. Also with the question of operating profit and loss, that is a widely used measure by users and researchers, and it is a weakness today that it's not standardized, not clearly defined, and we also support that effort to make it more uniform. Then we have some issues with that I will take up in my remaining remarks about where we have some issues about how we divide the different categories. And that was actually also mentioned by Ida. The first one on the bottom of these slides is the question of cash and cash equivalents. So there were divided views in the EFRAG TEG on this question. So on the one hand, these are financial assets. So we could do with those, if we were talking about, I'm talking now about non-financial enterprises. So the usual thing would be that financial assets, the return on financial assets is then investing income in the new setup. But on the other hand, one can say that cash and equivalents, they are maybe part of the treasury management of firms, so they may belong there, and that was the solution that the IASB found. And then both on practical terms, it may be perhaps it is more easy to just say that all financial assets they are included in investing, but on conceptual terms, the IASB may have a good case with the solution. So TEG was divided on this question, and the instinct of TEG is always to ask constituents to come up with their views when we are in doubt. And the same thing is the next question, the time value of money, which was also mentioned by Aida. That is the question of unwinding or discount on non-financial liabilities. So this unwinding, that would be typically provisions, legal provisions, that could be decommissioning provisions and cleanup provisions and all those kind of things. Is it true that we should, from a conceptual view or a practical view, is that a part of financing? I think you can always argue that pension interest on pension liabilities have a flavor of financing, but it's not for a legal liability, for instance, that you measure at present value. It's not so logical to say that the unwinding of discount, which is simply to say that the settlement of this liability approaches, that this is financing. So we were divided there. Next slide. So one more concern that we have is that the new structure of the income statement, they use the same labels and headlines now as the cash flow statement, but they are not identical. And the main, to give an example, is investment in operating assets, for instance, which is clearly now a capex in the investing section, but the depreciation, which is the other side of it, is in the operating section of is operating income then, or expense. We have two concerns actually. The one is that we would like maybe more work to be done on IS7. It is an old standard and it deserves maybe some more maintenance, and but that I think everybody agrees upon that. And the second thing is whether it's good to have these similar headings for things that are not similar. Then I understand that we should not talk about banks and financial institutions and conglomerates. That goes somewhat into that, but it's a more general issue actually, because we have discussed this question about the possibility to move financial items to the operating, and that is also an option for non-financial entities that have financing of their customers as part of their core business. So a car producer that also has customer financing, for instance. So the question, so that is clearly inside the proposal from the IASB, that they can define that as core business. But if they have their car production and their financing as different segments, it may also perhaps be logical to have them separated also in the income statement. So we would like both the constituents and the IASB to think a little more about that issue. Yes, and we can change the slide. And then on the question of integral and non-integral associates and joint ventures, that is a very new proposal. It is clear that what we see from European companies, at least, it's very unstandardized classification of these things, and they may have the reasons. Some may consider that their associates and joint ventures are part of their operating activities, and other may consider that these investments are more, investments that should be in the investment. The return on these should be in the investment section. So then it may be a bit strange that these joint ventures and associates get such detailed treatment in the income statement. So we actually get, so if you look at Aida's income statement, and we have two lines actually for those things, and we have subtotals that also is divided, so that we give them a very detailed presentation actually, but maybe that is necessary for solving this issue of non-standardized things. So I think in general that we are also mostly in favor of this proposal, but we wonder if the criteria for dividing the integrals from the non-integrals are sufficiently developed. So that also is something that we would like to have more input on from constituents. And the last question on this slide is the question of whether income tax also should be taken up. The fact is that the equity method, of course, is after tax issues. So if we are talking about standardization here, it is a bit strange that we have after tax income in those lines that are in principle before tax. So that is also a question so that we would like to be discussed. So last slide. That is what we are that we have heard from Aida, the question of the choice then of operating in the analysis of operating into expenses by function or by nature. This is something that we also have today, and but now there is a proposal to make some more discipline in it, in the sense that mixed presentations are is not to be allowed. And there were some discussions about this in EFRAG TEG also, whether we agree that there is some these are there is some kind of mixture, and that it's very common, as was Aida's example, to have cost of sales and then align with the depreciation. And I think that if you look at those financial statements, most of the time, or I would say more than 90%, the line of depreciation will be identical with the note on depreciation of property, plant, and equipment. So then one can say that maybe the accrual to cost of sales is not exactly precise, but then there is a question of whether we gain very much on having more discipline on this question. So we have the general question on the bottom there, whether we shall have whether we shall really go so far to have this prohibition against the mixed presentation. We have also a question to the IASB, or we discussed whether it was quite clear these lines that shall come in, that is in paragraph 65 of the discussion, now the expression draft, that says that there are some lines that shall always be presented. And it has a bracket reference to B15 of the same document. We are uncertain whether this is quite clear, whether, for instance, a line of impairment on property, plant, and equipment and on inventories should be always presented as a separate line or not. We are not convinced that it is quite clear the way it's formulated. I think I will stop there. Thank you.
And for interesting perspectives and views, we understand that there's a lot of discussion going on in EFRAG, and there's a lot to discuss in this part of the document as well. We will then hear from a couple of those groups that will be affected directly by this proposal, and we'll start with some preparers' views. So I'll ask Morten Haukaas, the Chief Accountant of Equinor and also member of NASB, to give us some views on the proposal, and in particular then on some aspects of the income statement. Morten, please.
Thank you, Karina. And first of all, I really appreciate the effort by the IASB to increase the relevance of financial statements and support the direction of their projects. The exposure draft proposes significant changes to how information is to be presented in the financial statements. I would like to highlight that all changes that result, in particular to changes in the IT systems, comes with an often significant cost to preparers. Also, as a backdrop, we should keep in mind that we recently have implemented the major new standards on revenue and leases in 18 and 19 respectively, that require significant changes to systems and procedures. So the IASB should hence consider carefully the cost of implementing the proposed changes so soon after these major projects compared to the anticipated value added for users. Based on learning from those projects, we also see that the proposed implementation period is 18 to 24 months from the date of the publication of the final standard. If significant changes to IT system is required, as the proposal indicates, 18 to 24 months is in the tight end, based on what we learned from the IFRS 15 and 16 projects, and more time should be given to implement. Comparability is key to better understand and evaluate financial performance across companies. But to be of value, comparability should predominantly be within industry against peers and not across industries. And if tighter, not fit for purpose presentation is required, this can be a catalyst for additional emphasis on alternative performance measures outside the financial statements, and the risk of then reducing the relevance of the financial statements in themselves. We observe today a variety in how information is presented and unclear definitions used for subtotals. Clear definitions as proposed will reduce this risk and increase comparability that we support. But it also comes with a cost. Subtotals matter and are reviewed by decision makers and users, and a mandatory definition across industries may force focus on subtotals that may not be the best measure of performance for that company or industry. So we believe definition should be required, but more flexibility with regards to which subtotals to be used. For example, EBITDA is mentioned, that now will be in conflict with the current proposal and then have to be included as a management performance measures instead on the front of the income statement. Our main concern with the exposure draft is the proposal regarding integral versus non-integral associate and joint venture. Company setups that are typically used in our industry, energy industry. This proposal will not be helpful, as it will not be linked to what represents our main business. And that is what should be interest of the users. Significant investments in our main business will then be reported as an investing activity due to it not meeting the definition of integral. Let me take an example. If we, for example, were to invest in 2 equal renewable offshore wind farm projects that are considered joint venture based on the contractual setup. But for one, we are the ones selling the generated electricity, while for the other one, our partner is. Then one of the projects will most likely be an integral and the other non-integral, and hence have different classification in the income statement, one as from the operating category and the other from investing. And I question whether this classification will be useful for the users. So I think the definition and criteria is not appropriate and will also lead to judgmental differences. We rather propose a split with regards to whether associate or joint venture are part of the entity's main business or not. It is investments in our main business that generate earnings that should be of interest to users. With regards to analysis of operating expenses by nature or by function, I represent an industry where a mixed approach is often used. And I must say, has served us well. A typical example is exploration expenses. A change will have a significant practical implication of changing our system. And as I mentioned, changing system, IT system, is expensive. And the benefit of reducing that option to use this mixed approach should be considered whether it's outweigh the cost of implementation. We are also a strong supporter of converged standards between IFRS and especially US GAAP. This proposal will increase GAAP differences and decrease comparability between IFRS and US GAAP reporting entities that will not be helpful to users, as the energy industry is global and a lot of our peers report according to US GAAP. We really encourage the IASB to continue to work with the FASB on converging accounting standards, and especially one so at the core as reporting of the primary financial statements. One final comment on goodwill. The amount of goodwill is already included in the notes to the financial statements, and I don't see the merit for why this element should be so special that it requires a separate line item in the balance sheet. I think I will end my comments on this section here, Karina.
There are interesting views and definitely things that we need to continue to discuss as this project is worked on and we approach the final comment deadline. I will then ask Teodor to share some views from the user perspective, and then we will ask IASB and EFRAG to share some views on those things that we've heard from Morten and Teodor immediately after that. Teodor, please.
Thank you, Karina, and also thank you for giving me the opportunity to share some thoughts here. On a daily basis, I work as a stock analyst covering the oil and gas sector, so of course my views are heavily influenced by that fact that I'm a stock analyst. So I just first want to share some thoughts around my general comments on what I believe is important for financial reporting seen from a user perspective. Number one is that it's consistent reporting over time for the same parameters. Do not hide information in text that actually could easily be presented in tables, and use the same reporting format as peers. I'm not very concerned about the same reporting format across industries, but it should be roughly consistent within the same industry. So I think that's three key comments from that will actually apply for most users. And then more specifically to today's topics around firstly subtotals and categories. I definitely think it's important to standardize definitions for subtotals, for example, operating profit. But I'm also a little bit surprised, like many other users, that actually definitions of EBIT and EBITDA is not standardized. So actually giving a definition of EBITDA could also be useful for users. And again, when it comes to subtotals and categories here, I think it's most important that it's the consistency within the sector and not necessarily across sectors, but within the same sector. For example, in the oil and gas business, I observe that some companies refer to EBITDA. Of course, I'm aware that that's not a gap measure, but refer to EBITDA as actually EBITDA before exploration costs. So that should be a EBITDAX. So I think it would be user-friendly also to look at that issue. When it comes to the issue around integral versus non-integral joint ventures, it's a little bit unclear for me how one will define this equally across sectors and companies. And I definitely agree with Morten's view here that the distinguish between integral and non-integral is less important. It's a type of underlying business that should be important. For example, if you have a joint venture that is driven by totally different factors than your main business, maybe that should be a more important way to distinguish rather than whether you have control or not, or whether it's an integral or non-integral. So my view is that joint ventures with the same underlying exposure, for example, for an oil company, if you have a joint venture that also sells oil and gas, that should be booked high up in the income statement. And I don't have any view what you call that actually, whether that will be a integral, non-integral. While if you have a joint venture activity that is unrelated to your key business, for example, for an oil and gas company, that could be offshore wind, which is driven by more the electricity price than oil and gas prices, that could be booked or should be booked lower down in the income statement. And the key issue here for analysts is what kind of earnings multiple should you assign to the different types of earnings. Another issue, of course, here, which already has been mentioned today, is that if you book joint venture income according to the equity method high up in the P&L, you will, of course, have some challenges around the margin analysis. But I think still, seen from a user perspective, the issue around which earnings you should assign which multiples or earnings multiples, that's more important. And then regarding OPEX by function or nature, I believe that nature is maybe most intuitive, at least for natural resources. If you book by nature or maybe a mix, then it's easier to understand the underlying business, and also easier to model future cash flow and model future earnings. I think for capital intensive sectors, it's very important, irrespectively of whether you have by nature or function or a mix. It's important to show depreciation on a separate line in the P&L, and such that you don't need to look at the notes to actually find the depreciation and or amortization cost. And again, consistency within the P group is the most important. And overall, I don't have any very strong views on whether functional nature is the best. If I must choose, I would choose the OpEx by nature. And finally, a few comments on cash flow. I know we haven't been through this yet, but just to time constraints, because I need to leave in 30 minutes, I will also share a few comments on my view on cash flow and IASB's proposal. So as far as I understand, the preferred choice is starting the cash flow statement at operating profit. I definitely believe that makes sense. That's a very user-friendly starting point, and I believe operating profit is a better starting point than, for example, net profit, because then, of course, you very, very clearly actually see what is paid as cash tax. When it comes to like incorporating the joint venture earnings in the cash flow, I think that's a little bit challenging to have any strong views on. There's good arguments for including including earnings from joint venture in the operating cash flow if it has the same underlying business risk as the company, and also if earnings are recurring. I would also then finally just to make a few comments on the indirect versus direct method, although I know that's not on today's agenda, but I am a big fan of, and I know most users in the stock analyst community also are a big fan of the indirect method, as that provides a better understanding of how the business actually works, and it's easier to reconcile with P&L and balance sheet.
Okay, thank you very much, Teodor. I appreciate your views. As you said, you are not with us all the time today, but we hope to get your views also on the next topic. But before we move on, I would like to hear if either Aida or Françoise would give us a few comments on what we've heard from the other speakers. Thank you.
Thanks, Karina. So I'll just say a couple of things and really start by thanking both Morten and Teodor. It was really helpful input, and I actually got some ideas from what you've just explained for how to improve or what to suggest to the board to improve proposals in the redeliberations, which is really great when it happens. You made lots of points. In interest of time, I'm not going to comment on everything, but I would just highlight a couple of things. Morten, you were talking about balance between mandatory defined subtotals and then flexibility that is useful for companies. And this was really something the board discussed in lots of detail. And I think the comfort with the EED came from the fact that it was felt the proposals work in totality, because on one hand we have the structure, which can be rigid, as you say. Some things, some subtotals that you see as useful may not necessarily fit in this new structure, but then this is complemented by the proposals that relate to management performance measures, proposals to separately disclose unusual items. And it was thought when you look at this package in totality, then you would get all information that you would want to communicate, that would be relevant to investors. So this is really balanced. I think we would agree that if you look at P&L in isolation, there are bits that are perhaps missed out, but I think that's just impossible to fit everything in one place. I think your comments on integral, non-integral are really consistent with what we've been hearing through the outreach. I think this is something, we need to do further work in terms of ironing out. I think, Morten, the example you've given where you think some of your wind farms investments might end up being classified as non-integral, which is, I don't think, how you see them. Perhaps, we can, I'm happy to discuss offline the exact fact patterns and how it will work, but this is exactly why this field work we're doing now is useful, to test these proposals, make sure the outcomes are as intended. I thought it was very interesting what you said, Teodor, about the underlying exposure being the key thing here for you. And when I look at how the board has defined investing category and therefore integral being the opposite of that. So
question number 3 in Slido, and I will ask the audience to go to Slido, because there has been expressed some different views on how to present results from joint ventures and associates, and this poll question is about that topic. So please, I will ask the audience to answer the question in Slido.
So the question is, do you agree that the result from associates and joint ventures should be presented separately in 2 different categories of the income statement? And we have 5 different alternatives here. So good if you can give us your immediate thoughts on that. We have quite some responses, and it seems that there is really not a full consensus, at least.
Yes, and I will ask the audience just to keep on answering, but then the IASB and the EFRAG, if you could just comment on these results that we see now.
Well, I think it's consistent with the messages that we are getting in these webinars. This is one of the elements where there is diversity in practice in terms of classification within operating and outside operating. So it's not surprising that the preferences are not consensual. And there is some more consideration to be done to the definition. This is what I see from the results.
Yes, I mean, I don't have anything to add. I think this just demonstrates the differences in views we have. I just think the users would be pleased with this outcome, that only 8% currently from people today think the results should be presented in the operating. And, this is, remember, something that users generally told us they don't want to see. So that is kind of good. But then it's clear that there is no clear answer exactly how to deal with it at the moment. So we'll have to work more on this.
Thank you. We have by no means covered all aspects of the income statement discussion, but we will have to move on to management performance measures and unusual items. And to the audience, please continue to ask questions. We will try to revert to a few of them towards the end. We might not have as much time as we thought we might have to cash flow statement discussions. It's not a big surprise, but the questions you ask will be brought into the process whether we manage to cover them in this webinar or not. So please continue to ask your questions and give your comments. And if I then can ask Françoise to give us your thoughts on performance measure, management performance measures and unusual items, and that part of the proposal, please.
Well, happy to do so. I mean, the management performance measures proposals are an important feature in this exposé draft. We have named them management performance measures, and I will come later to what is a subset of non-GAAP measures that we are covering here. What I would like to highlight is that depending on the jurisdictions in which you are, regulatory requirements may vary. So for a European stakeholder, the ESMA regulation on alternative performance measures is well known and applied in practice. So what we are suggesting here has a lot of common aspects to this regulation in terms of alternative performance measures having to be described and their relevance explained. The changes that may happen from period to period be highlighted and also explained. Very importantly, a reconciliation being required with in the ESMA regulation profit or loss. Basically what we are adding here at the request of users is having access to a single note, having this information, which is very important to them. I highlighted earlier that users have clearly indicated that these non-GAAP measures, alternative performance measures, and what we call management performance measures are important in the analysis. They may be all the more important that today we have no required subtotals, but they are important to the analysis. And they need to have an easy access to that information, which is important to them. What we also adding to what exists at present is the requirement for highlighting tax and CI effects, and that's also a very specific request of users who are very interested in management's view in those measures, but want to be able to make their own assessments and derive their own number from what is provided to them. So as in the or similarly to what ESMA regulates, those measures are those which are used in public communications outside financial statements. They come as a complement, useful complement, as I said, to what is specified in IFRS, and have to be management's view of an aspects of the entity performance. So on the next slide, we really want to make very clear that we are in encapsulating MPM, taking only a subset of alternative performance measures altogether, and financial performance measures more particularly. We set aside everything which is non-financial measures of activities, such as number of subscribers or the examples on the slide. It's important to highlight that in terms of financial performance measures, there are a number of IFRS specified subtotals. Of course, the three new subtotals come in addition to that. Aida has just highlighted the operating profit before depreciation and amortization that we have included as an IFRS specified, so that it would be is there to be used in the income statement if people want to keep closer to IFRS specified IFRS numbers. And the management performance measure is one of those financial performance measures that tackles an aspect of the entity performance, but in an adjusted way. And it's, it comes under various labeling in current practice. I want to highlight that in a small desk survey that we conducted, we identified that up to 90% of companies are using this type of measures. And we have not included, and I understand from what comes from our consultation period that this is questioned by a number of people. We have not included other measures which are not subtotals of income and expense. Finally, as in the next slide, an overview that comes in a way as a summary, and that highlights what would be changed to current situation. So I emphasized the need of users to find that very important information to them in a single note to the financial statements, well-identified location. An important aspect of the user request has been that if this is presented in financial statements, it will be included as part of the scope of audit, and they put a high price to that assurance on very important information to them. The content of disclosures, I think I highlighted that they're very similar to what exists in terms of regulatory guidance in Europe in particular. I also highlighted that the disclosure of tax and NCI effects would be new. And finally, something that when European stakeholders consider this issue, I would like them to take into account is that we set standards for across the world, and there are a number of jurisdictions where regulatory requirements have not been set, and we also have in our objective to assist users in every jurisdiction. So that's also a way of in fact bringing all investors towards financial statement presentation on the same level. That's what I wanted to present as part of this section of our proposals. Thank you.
Thank you very much, Françoise. As Teodor then has indicated that he will have to leave us quite soon, I will ask him to share some views also on this part of the proposal before you leave us. So please, Teodor.
Yes, thank you, and also thank you for making time earlier in the presentation for me. For NPM, I just have a few key comments, so I won't spend too much time on it. The first one is that, seen from a user perspective, management performance measures are definitely important to understand the underlying business, and also important to make reasonable estimates going forward, both for operational metrics and also for financial metrics. In particular, also I use non-financial disclosures, which were mentioned earlier here, for example, subscribers, production for oil company, etc. Although I know that's of course not NPM by definition. So again here, I think for NPMs, it's important with consistent reporting over time, such that the users actually get used to looking for these numbers specifically, and also that they know where to find it. And my second message today will be that that you need some tables where you can actually reconciliate with the IFRS figures. For example, if a company reports adjusted EBIT or adjusted operating profit, like for example Morten and Equinor are doing, then it's very important to understand how you should bridge the IFRS number with the NPM number. And it's also important that this kind of reconciliation looks similar for every quarter or every reporting period, such that you actually can trust the reconciliation. And if you've been through that a couple of times or several times, you can actually maybe just use the adjusted operating profit, for example, directly to assess share price impact from the quarter report that specific day. So the consistency here is very important to gain some confidence in management's adjustments. And then just finally, one comment that I didn't include on the slide there, but of course there's special times now with the virus situation, and I would expect many companies to use the COVID-19 situation as an excuse for low Q2 earnings, and maybe report some, you can call it non-recurring corona cost. I think one should be very, very careful of including those effects in MPMs and, for example, an adjusted operating profit. Although I know this is, of course, a little bit on the sideline of the topic today. I think that were all my comments. Thank you.
Thank you, Teodor. Are there any comments from the other panelists to Teodor while we still have him with us? And while you are considering that, I would like to ask the audience to look through the questions that we have in Slido and press like on those who you think are the most important, so that we can get to the most important questions first. So anyone who would like to comment on Teodor's views? If not, I think we move to some comments from EFRAG to the MPM proposals and unusual items. So I think it's Chiara who will give us some views there. Please.
Sure, thank you. And as Françoise was saying, this is one of the pillars of the exposure draft, and was also one of the topics that absorbed more time in our discussions. We know that there is a problem of transparency, clarity in the financial communications because of the use of these alternative performance measures, or MPM as the IASB is now defining them. But as this is also the most innovative element of the proposals, there are also a lot of resistance, like often it happens when we are close really to a step ahead into the future. Because so far the problem was mainly focused on the communication outside the financial statements, and similar to what the panelist before, Morten, was saying, we also highlight in our comment letter a series of concerns around the proposal to include the disclosure on MPMs into the financial statements. The concerns go from the quality of data to the consequence of costs for auditability and costs of audit, because virtually everything can be audited, but it can become more costly. But also due to the undue prominence that this proposal risks to give to the non-GAAP concepts. So those that had all these the resistance and concerns ended at the end. We ended in a mixed views. So we had a split group because at the same time there were the other camp that clearly saw the potential really to bring a discipline into this process. So that's why we are consulting our constituents. You see in this slide the proposals that we are doing. We propose a more narrow scope than what the IASB is having. So, for example, the first scope is to limit the presentation to the management commentary practice statement and the financial statements. Or the other scope is to include only the communications that are issued jointly to the annual and interim reporting, including an earlier releases. So there was a comment that the definition provided in the ED that all the communications have to be scrutinized was a bit unclear. So we tried to ring fence with these two possible scopes. Then we also have comments and questions on cost of and benefits of splitting the tax and the NCI effect in the reconciliation. There is also an overarching question around the NPM. As Aida was pointing out at the beginning, this proposal of NPM is very much complementary to the new structure of the profit or loss. So we have more rigidity in the structure of the profit or loss. And the question mark is how the market will react. Will we observe an increase in the NPM because they want to continue to convey their own managerial way of looking at the performance? So is there a push to increase the number of NPM? Or on the contrary, since now we're getting more discipline around NPM, we will see a lower number. So this is what also we are keen to see from constituents and from the preparers. Few words on the next slide on how the proposals compared with the ESMA guidelines. As Françoise was illustrating, the NPMs are limited to the indicators derived from subtotals on the phase of P&L. Which is something that we are criticizing because we think that the definition should be more broad and include also indicators of P&L and other of balance sheet and other ratios. And this is also the case in the ESMA guidelines. And also the scope of application is a little bit different because the ESMA guidelines do not cover the financial statements unless an indicator is also proposed in the outside the financial statement and in the financial statement. So the scope is relatively different. Do I have a next slide? Yes, unusual income and unusual expenses. We also see a lot of potential of usefulness for these proposal to have in one single place this type of information because the adjusted income, which was also the indicators, which was also commented by Teodor, it's really, really important, almost always present, is trying to exclude from the profit those items that have limited projecting value. So we think that this is serving an important role for the proposal. Nevertheless, we criticize the actual definition because we think that the IASB should consider also that some processes of transformation, restructuring may last some years, but still be unusual for the entity. So instead of focusing on the fact that they are not going to occur again, we would invite them to consider a broader definition and to consider also that these processes may last some time. Then we had some discussion before arriving to a conceptualization of this definition on how it would overlap with, for example, exceptional items or non-recurring items, and we discussed a lot. So it's important to really focus and clarifying on this definition. And there was a question on whether the entity would be allowed to label unusual an item on the face of the financial statement. So these were the essential points of our discussion.
Thank you, Chiara. It's interesting to hear views on all of these topics. It's complex. It's a lot. I realize that Françoise did not give the background to the IASB's proposal on the unusual items part of the section, as he was kind enough to allow more time for Teodor as he is leaving us. But perhaps, Françoise, we could return to you now and have a few comments on the unusual items part of the proposal?
Thank you, Karina. I welcome doing that. As Chiara has said, in fact, when we look at unusual income and expenses, we really want to capture those income and expenses that have limited predicted value, those who are really significantly disruptive in trends. So we have set that our definition having in mind to set a high bar. My understanding, and you know that when we IASB members speak, we do that expressing our own views. So here I want to highlight that I'm expressing my own understanding of what we are trying to achieve. I think we are trying to identify transactions, individual transactions, events, plans that an entity incurs, and that we would see these as individual items, even though they would affect several periods. But what we are certainly trying to fight, and we are trying to fight that because we are being told by users that they cannot longer rely on income and expenses being described as unusual when there is, in fact, every year, for example, a recurring flow of restructuring costs. That's often the example that is taken. So if an entity indeed restructure on a very regular basis, this would certainly not meet our definition. Whereas when there would be a very significant restructuring movement, strikingly different and very significant compared to the recurring flow that the entity is used to, that would qualify. So it's basically nature and magnitude that we are approaching there. And we also highlight in our proposals that what stems out of recurring remeasurement of items would not normally be classified as unusual, even though they are generally considered, those movements in value, as having by themselves limited predicted value. That's just the outcome of the measurement, and it would not qualify. So with those proposals, in a way, we are seeking to improve what may qualify as unusual income and expenses. We also ask that this is provided in the notes to the financial statements and not shown in the income statement itself. Thank you for giving me the opportunity to cover this issue after the first comments.
Thank you, Françoise. It's really interesting. And again, it is an important question, and I find it very difficult to form a view myself on this area. It's one side, there are good arguments for this, and there are good arguments for the others. So it's a challenging area. And now I will ask Morten to give some comments from a preparer perspective, as one who is involved in providing these measures and trying to strike the balance on how to do that. So please, Morten.
Karina, and as you said, we are one of the preparers that today have what we call additional performance measures in our quarterly financial reporting. First of all, I support the effort to increase transparency and provide guidelines relating to the use of alternative performance measures in financial reporting. Comparability and understanding of the numbers used is as important for alternative performance measure as it is for IFRS number. But by nature, alternative performance measures will be more company or industry specific and it should be careful to constrain what could and should be disclosed. We need to remember that the existence of APMs is due to that the current IFRS do not provide what the producers want to, preparers want to show, and also analysts use is what we often label underlying or adjusted earnings. In the proposal, IASB are proposing to include a subset of alternative performance measures within the financial statements as part of a separate note disclosure. Why the IASB proposal to only include a subset of performance measure that are subtotals of income and expense and not, for example, ratio or free cash flow? Why only the subset is helpful is unclear. And I also think the proposal will result in useful information now being spread out throughout the financial reporting. Because I see that from a user perspective, then we will have the IFRS numbers in the primary financial statements. Then we will have a subset, what we call the management performance measures in the notes. Then we will have the remaining alternative performance measures outside the financial statements, but within the financial report. Then what is defined as unusual items that I'll come back to in a separate note. And to add on, we also have this issue with integral versus non-integral associate and joint venture. So you could start asking, what numbers should the user look for to assess financial performance or position? I'm not sure this represents better communication. And if the IASB were to include alternative performance measure within the financial statements, then they should not put constraints on what to include, especially with regards to, for example, ratios that again are actually based on IFRS number. We see the need to regulate the use of alternative performance measures, but I also have to comment as a Norwegian company, our adjusted earnings measures are already covered by the Asthma guidelines and do hence not see, I can say, the value of splitting out a subcategory of our APMs into a separate note in the financial statements, because that is more, I can say, spreading out information instead of having it in one place. Then some comments on unusual items. I must admit I'm a little uncertain about the value of the specific disclosure requirement with regards to unusual items that should have limited predictive value and not expected to arise for several future reporting periods. You could argue that the definition is vague and narrow, and I also expect that this will reduce the number of items to be reported as unusual items. In addition, it will be highly judgmental. Significant items in a quarter are of interest to the users and should be highlighted in the financial statements as part of management commentary and in the notes. But again, uncertain about the value of the proposed proposal, where these items that only those that are fitting the definition as unusual are gathered together in one note. You can also have example of, okay, if you have comparable, that for this specific quarter, we have something especially on a typical line item that is 10 times or double the amount that usually. In the comparable, should you then have 0 because it was not defined as comparable as unusual last quarter? Or should you actually have the amount in there, so then you have suddenly new information? Also, alternative performance measures or management performance measures also take the role of adjusting the results for items not considered relevant for assessing future performance. And it will also be then covered by the APM reconciliation to the closest IFRS number. So any unusual items very often will be adjusted out of the IFRS numbers, will then be reconciled and reported on in as part of the MPMs or APMs. So we support proposal on disaggregating information that is important for understanding of the financial performance or position of the entity in notes to the financial statement where significant items should be disclosed, but uncertain about this definition with regards to unusual. Thank you.
Teodor, are you still on the line? No, I think we've lost him. Then it's difficult to ask him to follow up on his comments. Then I think I will ask whether the IASB representatives have some comments to what Morten have told us. And while we're doing that, it would be good if we also can prepare for the poll question number 4 on the MPM, so that we can hear what the audience is thinking about this issue. So are there any comments from either Aida or Françoise?
Aida, please comment, because you have the full perspective of our outreach activities. So.
Thanks, Françoise and Karina. So just again, thank the panelists. And I think what you've heard today is very representative of what we hear in the outreach. And I don't want to interpret what Teodor has said. A shame he's no longer, he couldn't stay on. But my understanding is that his view was that the proposals would be useful to users, that will bring consistency. But then I heard concerns from Morten about this being seen as mere duplication of what Equinor is already doing to meet Asthma guidelines, and this is a kind of common theme we've been hearing. And I just want to add that really our discussion with users of financial statements, and this includes many users in Europe, has been very supportive for the proposals for MPMs. And I would like to say even discussion with many of the regulators as well, who actually see this as just aid to what they are doing, because it is seen that the transparency and discipline would be enhanced by bringing this as a note in the financial statements, because of all the constraints there are with the financial statements, because financial statements are subject to audit, and it's just easier to kind of ensure consistency over time than perhaps outside financial statements. I take your point. I mean, these measures would not be comparable, and the objective is not for them to be comparable. They are entity specific, and it is what management thinks communicates performance. I heard interesting comments from you, Morten, about concerns about the spread of this information throughout, because MPMs are limited to income and expense subtotals, and this limit came about, and back, I think, Chiara, you mentioned it again, because it is meant the proposals complement the subtotals in the P&L, and therefore it only made sense to have a MPM as a subtotal. We have one exception already, that the proposals also cover companies that disclose adjusted earnings per share. So if they do adjusted earnings per share, the adjusted earnings part would have to be an MPM, but we haven't gone further with the ratios. I mean, we had feedback that from lots of users who would like to expand the scope. They say, oh, this is good, why don't you do more? I think it's something we would have to discuss, or we would discuss with the board. The question is whether the board would be willing, because then it moves away from being a complement to the subtotals, which are, I would say, the key thing of the project, defined operating profit, to something else. So it will be a question whether the board is willing to do it. At this point in time, I just want to note that this doesn't necessarily preclude the inclusion of other information in the financial statements. It is just that they would not be MPMs, and they wouldn't be able to be identified as MPMs. So yeah, I think that's it.
Kjell, will you then take us through the poll and some questions, please?
Yes. We can see the results from the poll question on MPMs is that there is a majority that want to include MPMs in the financial statement, but that the IASB scope is too narrow. And when we go to the Q&A in the Slido, the most popular question is just about that. Why did the IASB choose more narrow definition of MPMs compared to the Asthma guidelines? And there is also an a question in the slide that is related, and that is about whether MPMs in the financial statement is a temporary solution until Asthma guidelines or other guidelines has a global reach. Would you, Aida, comment on the narrowness and whether this is a temporary solution?
Sure. So I think on the narrowness, I just want to reiterate again that the idea was that these are complement to subtotals, and therefore it made only sense to, with that objective, include subtotals of income and expenses. But of course, as I said, that we will, listen to the feedback, and the board will consider the feedback received. Just to note, we also have a project on a management commentary that is also looking at the broader performance reporting. And we are working with our colleagues there as well, so they'll be discussing it too. I think on the short-term solution, its standard setting is not a kind of short-term unless you are in Corona situation, and then we make amendments in a month. But that's very much exception, I think. So I don't think that was the objective. It was really as set out that, having something in the financial statements is even supported by regulators themselves. In a way, you can say regulators today fill the gap because there's no guidance for this in the standards, and these measures are used, and therefore they felt the need to address that. And their regulation will remain relevant because the scope of that regulation is much broader than what is included in the proposals for management performance measures.
Yeah. Any comments from the EFRAG? Yes, please.
If I may add to that, this is Françoise. I understand that we hear a lot of suggestions that our scope should be widened. And I think Aida has perfectly expressed where we come from. I think if stakeholders believe that we should widen, I think they should also try to recommend us not only a list of examples of what would be of interest, but try to make some recommendation as to what would be the principle for us to increase the population. Because as Aida explained, we would be moving aside from the approach that we have followed, which has its internal consistency today. So if we were to have to widen, it would be important to have a guideline on how to do it.
Yeah. Any comments from EFRAG on this topic?
Well, I think I have already illustrated what our position. Of course, we are keen to see what our constituents reply in the letter. Then it's very interesting to see the feedback today with the majority. So it seems that your jurisdiction is ready to go in the financial statement with this big change.
Okay, thank you. Back to you, Karina.
It would be good, Kjell, if we can take also a few questions on the income statement at the same go, as we did not cover that due to the time constraints we had in that part of the session. And then we will be very short on the cash flow statements as we have just over half an hour left of the time we've set aside, and we will do our best to finish on time. So if you have a few questions.
Yep, that's okay. And the most popular question on the income statement is directed to the IASB. Is there a definition or description of nature? What does nature mean? Do you have any comments on that, Aida or Françoise?
Aida, please.
Thank you. My mouse stopped working to unmute myself, but I managed to do it. Yes, indeed. So it's a good question asked, definition or description, because we don't have a definition, but we have a description. So I can answer positively. So description, so this is about analysis of expenses by nature, I presume, the context in which the question was asked. And what I would just actually read it to you to make sure I give faithful representation of what is in paragraph 69 here. So the nature of expense method provides information about operating expenses arising from the inputs that are consumed to accomplish entities' activities. And then we have some examples, such as information about expenses related to materials, equipment, so example, depreciation or intangible assets, example, amortization, without reference to how these are allocated by function. So it is basically your inputs used in your processes of making goods or providing services. So we didn't go any further into defining, but there are some questions I think arising sometimes whether this is nature or not. So I do encourage you in the comment letters again, if you have a specific concern or the need for clarification of something, to refer to it. But overall, I think the objective was to be principle-based rather than prescribe exactly what are the items, because it will very much also depend on the industry, what becomes material, and we didn't want to end up with a clutter by prescribing a list.
Okay, thank you. We have also received a question that is concerned about immaterial results from associates. When we have a separate line, but if the numbers are immaterial and we have a subtotal before and after these results, will we see immaterial lines in the income statement?
I hope not, Kjell. So I haven't unmuted myself, so I can come in quickly. So the materiality applies to everything, even if this is described as a minimum line item. So if entity has non-integral or integral associate and joint ventures that are not material, then even though it's a minimum line item, they wouldn't be required to present it. I just want to give a little caution here, though, because sometimes I think some stakeholders think of materiality purely in a sense of number, and can say, oh, I didn't have much profit from this associate and joint venture in the particular period, and therefore I'm not going to present it as a line item. But if this associate and joint venture is material investment as such, then I would argue that maybe this conclusion may be not most appropriate. So just a warning that it's not only assessment of the profit number, but you need to look at the whole investment as a whole, whether it is material to entity when making this judgment, whether to present separate line item.
Yes, and the last question on income statement that is quite popular is, I think you have touched upon it before, why is it important to prohibit mix of nature and function? Yeah.
Yes, so we heard some differing views here, didn't we? And I'm quite interested. I actually had a look at Equinor financial statements that make an interesting go at mixing, and we'll be interested actually in talking to Morten after this to understand better why this method is chosen and how. I think, as I mentioned earlier, the underlying reason was this feedback that it becomes unclear what is complete and what is not complete, and users can be misled. And I gave earlier example of cost of sale and depreciation, and then it is not clear which one is complete and which one is incomplete of the two. They both can't be complete because the expectation is that there would be some depreciation in cost of sales generally. So this was really the drive, and I think this particularly became important when we look at taxonomy and electronic reporting, where companies would capture cost of sale as a line item, and then users might just pull that particular line item without looking at the total financial statements, and then they would have no idea if this cost of sale excluded I keep using depreciation, but there could be other examples perhaps or not, and therefore even more scope to mislead the users. So this is really that, but there is lots of feedback on this. I think we need to consider this further. I think also consider what EFRAG has commented in that, is there a scope for maybe some of the additional line items that are currently not described as minimum line items to also be exempt from this prohibition. So one common example we have heard is, for example, goodwill impairment, and that users would like to see separately regardless of nature function. So we will certainly look into this more.
Okay, thank you. Then I think we'll take one more poll question number 2, before we go to cash flow. So if you can go into Slido and just answer the question on the categorization. Do you think that the new required allocation between operating, investing and financing of items in the subtotals will result in better information? And the alternatives is yes, it will improve comparability. No, as it will impose uniformity. So please give your answer to the question. And in the meantime, we have received a question on whether the IASB has a plan to define main business. Any comment on the definition of main business, Aida or Françoise?
So this is really not something we discussed in detail today, because it's only relevant for entities that provide finance to customers or invest in the course of their main business activities. In other words, I'm talking about banks, insurers and the like, because subject to these principles, then they would be required to move items from financing or investing categories into the operating. And we don't have a definition as such. We have an indicators where for example, we have said if company has this provision of finance or investing as a separate segment, then this is the indicator that it is the main business activity. I think the underlying logic or the underlying thinking for this was really to capture those for whom investing or financing income and expenses would be part of their key performance indicators. And we gave an example. So for example, net interest income for a bank includes interest revenue, interest expense, and this is a key performance indicator. And for them, we want this to be presented within operating profits. So this is really the driver for this proposal. I think for main business activity issue is really like for, banks generally don't have a question, do we provide finance to customers? Is pretty clear. I think that this becomes more of a question when you have conglomerates, companies with multiple business activities, and then this is one of their business activities, and sometimes there might be judgment involved as to whether this is their main business activity or not. So we have a few of those companies participating in the field work and testing this, and then depending on the outcome of that, we will go back to the board to see if there's a need to provide more guidance on this.
Okay, thank you. And then we have the result from the poll question, and it seems that there are a large majority that support the categories. The 81% has answered yes, it will improve comparability. So I guess that there are no need to comment that result. So I'll go back to you, Karina.
Thank you, Kjell. And then I see that we have at least some time to cover also the cash flow statement. So I will then ask Aida to get back to us and give a presentation of the proposals on the cash flow statement so that we can also get some views on that part of the proposal. Please.
Thank you, Karina. And statement of cash flows is a little bit like an orphan child of this project, because it is really not what this project has been focusing on. Earlier on in discussions with the board, we had discussion as to whether to look at a statement of cash flows more comprehensively, in particular whether to look to achieve alignments between the categories in the two statements, and the board has decided to not do that, and this is driven by feedback from investors who did not seek that, or it wasn't on their priority list. So what this project is doing is really targeted improvements to the statement of cash flows, and this is also part of the reason that we are really proposing amendments to the statement of cash flows rather than merging it with the rest of the proposed new IFRS standards, because it's recognized that the more improvements are needed, and it's possible, depending on the outcome of the next agenda consultation in next year, that there might as well be a project focused at looking at statement of cash flows more comprehensively. But what we are doing in this project, it's two things really, and they're both stemming from the work on the statement of profit or loss. One is for companies that provide analysis of cash flows from operating activities using indirect method, to have a consistent starting point, which would be operating profit. And this is possible now because we have operating profit as defined, and that would reduce a number of reconciling line items compared to what some companies do now, which is start from net profit number. And it would provide consistency because not everyone does the same today. And the second part is really removing some of the classification options that exist in the statement of cash flows today. So today companies can choose where to classify cash flows from interest and from dividends. And what these proposals do is specify that these shall be classified. There's a little bit difference as to depending on whether you are general corporate, which is what we focused on today. So for general corporate, the classification would follow the classification in the statement of profit or loss. So for example, interest paid would be classified in the financing, interest received would be in the investing category. And for the other companies such as bank, the classification again would follow what they would have in statement of profit or loss. So for them, interest paid would be in the operating category, for example. And then we also have proposals on the cash flows from associate and joint ventures, which really flow through from proposals for the P&L, where the proposals for statement of cash flows is to have a separate line items for cash flows from integral and non-integral associate and joint ventures. But the difference between this and P&L is that they would all be in the investing category. The board, to have full alignment, we would have had integral category in the statement of cash flows, but the board didn't go there because, as I said, this would be considered more substantive change to the statement of cash flows, which the board didn't think was justified, given that we are not anyway doing comprehensive review of the statement of cash flows as a part of this project. So that is really all that is proposed for IAS 7 in this exposure draft.
And I managed to unmute myself. I would then ask, I think it's Chiara who will give some comments from EFRAG on also the cash flow statement part of the proposal.
Thank you. Yes, so we agree with the proposals of the IASB in this respect. We, in particular, support indicating the operating profit as a starting point for the indirect methods. We observe in practice now that entity interprets the current requirements in different ways, so they use different starting points, like profit attributable to shareholders or profit from continuing operations, profit before tax. So there is diversity in practice, and we think this proposal is going in the right direction. It also has the benefit of helping to reconcile with the new operating category that is now in the statement of profit or loss. However, as Erlend also illustrated at the beginning when speaking about the operating, financing and investing, we regret that the IASB didn't take the opportunity to further consider the alignment of the labeling and the categories across these two primary statements. So, for example, we will have some items that are classified differently. I mentioned only one, which is the interest revenue from cash and cash equivalent, which will be in the financing category in the profit or loss, and it will be together with all the interest received in the investing category for the statement of cash flows. This may create now confusion in the users. We understand that the ambitions with respect to the IAS 7 are limited in this project, as Aida was saying. Therefore, we really encourage in the future the IASB to consider more broadly the usefulness of the cash flow statements. For example, from European financial institutions, we received the message that this is not really perceived as fully useful. So and this is one of the elements of a separate future project we hope the IASB will undertake, but also to improve the consistency between the different primary statements.
Thank you, Chiara. I think we then turn to Morten to hear whether he has some initial thoughts also on the cash flow statement. I think, Morten, you might have a few things there as well.
Thank you, Karina. Not too much on the cash flow statement, because I must say that basically I support the proposal, and both with regard to the operating profit being the starting point, and also reduce the choices with regard to classification that exists today to increase comparability. The proposal that are made, I can say I support. One thing that I'm a little bit concerned about is in totality. When you look at a primary financial statement like the cash flow statement, you want to extract the useful information. And I must say that the split of integral versus integral makes that part of the statement get too much focus with regards to materiality in totality. In IFRS 12, we have disclosure requirements on joint arrangement and associate, and also additional requirements for what we call material joint arrangement and associates. Those requirements do not cover cash flow. It's basically income statement and balance sheet information. But my proposal would rather to be then add on some requirement in IFRS 12 on cash flow presentation for this investment, rather than to really expand the primary statement of cash flow. So, thank you.
Thank you, Morten. Interesting. We have about 20 minutes left of the time we've set aside, and I think we might want to do at least one more poll question. I think we have a poll question number 5 that is catching up on something that Morten was talking about in his first session on the implementation effort and implementation cost. It would be interesting to hear the audience view on that, in particular, as I think we have quite a few preparers with us on the line, and those are the ones who are providing that effort. And of course, there's also an important benefit from a preparer point of view, but it would be good to have some kind of views on what you think it's going to be. And after that, Kjell Ove, it's good if you can guide us through any additional questions that we have.
Yeah, and while the audience is answering the question, I can address one question to the IASB and the EFRAG. The one most popular question that is not addressed so far is whether there are any plans for webinars on banks, as we have scoped banks out of this webinar. So do the IASB or the EFRAG have any such plans?
From an EFRAG perspective, so far we didn't think about having a dedicated seminar, so we may, and it's an occasion with this question to think about it, if it is feasible, considering the overall planning. And the reason why we didn't do a specific webinar is that we have a financial instrument working group advising our technical expert group, so we have a good representation of the European banking sector there, and we are consulting with that group. But I welcome the question, and for sure we will think about it.
And maybe just useful to share with participants that a week ago we did webinar, so it was IASB staff did it, that was focusing on the subtotal, so it was comprehensive. We discussed financial institutions as well. We received quite a lot of questions and we answered them in the webinar, so this is available on IASB website on the project pages, so you can listen to the recording of that as well, if helpful.
Yes, and now we have the audience view on the cost question, and for the first time I do not know that's have the most responses, so that is something to reflect on. But what we also see is that very few things that the information is easily available. So a majority thinks that there will be costs related to this implementation to a certain degree. So was this an unexpected or an expected response to the question?
So, did you want to comment on this? I know we discussed the expected costs a lot in the effects analysis, or do you like me to comment?
Yes, please, just comment.
So I mean, I think I do not know is not unexpected, because similarly we were not quite sure, and this is why fieldwork is important again, to actually, whilst we might have opinions that something will not be costly, I think the best way to find out is to test it in the practice. I think overall the expectation was that it's not perhaps as much of effort as some of the recent standards that companies have had to implement, simply because this project is not changing any of the recognition and measurement requirements, as I understand it. It's all about, essentially grouping and ungrouping information in different ways. But even with that, as Morten was saying, with some of the analysis of expenses, that could require changes in the processes and or changes in systems. So we are really working with companies participating in field work to understand this better and to see if there are any costs that would not be justified by the benefits we expect from particular proposals.
Yeah, and if I may also comment on this specific point of operational implications, there is a bit of balance between the costs and the time of implementation, because the two may relate differently. And it was interesting for me to hear Morten before commenting on the timing needed to implementation and saying that time may be challenging. So this is something that we need to consider also very deeply in the interaction with the preparers. So not only the costs, but also the timing of implementation.
Okay, thank you.
If I may add to this, this is Françoise. I think, as Aida already mentioned, the results of the field test are key in, getting us a better understanding. But in our proposals, we have, in a way, a sum of proposals. So when people in their comment letters comment and provide input on the cost, it's really important that they identify more specifically what are this or that requirement which is bringing the cost, so that we don't have a response in totality, but we really have input on specific requirements which are bringing the cost, whereas the others would be easy to implement. So that will be very helpful for us.
Okay, thank you. Going back to the cash flow, it seems that there was not much disagreement among the speakers, but to test if this is in line with the audience, I would have the poll question number 7 in Slido, please. That is a yes/no question. Do you agree in operating profit as the starting point when using the indirect method to report cash flow? So then you can start responding to that question. And after seeing the result, I think I will go back to Karina. But first we will have the result. So far, it's a huge majority on yes. Very few say no. Yeah, so it seems that the audience agree with the speakers on this question. Back to you, Karina.
Thank you, Kjell. And I think we are approaching the end of this webinar now. First of all, warm thank you to all of the speakers from the IASB staff, from EFRAG, and our own NRS and NFF representatives. It's been interesting. And even though we've covered quite a bit of ground and many topics in this proposal, there are definitely several proposals and several aspects that we have not at all covered. So I would encourage the participants to continue to follow the debate, look into the material related to this proposal, as there are other elements that may be equally important to them and their businesses, their use of the financial statements, than those that we have elected to cover today. We had to make a small selection of the many aspects. And I think it's interesting to see that there are, even though we're not touching on recognition and measurement, there is potentially quite a bit of changes that might come out of this, and we might see other sides, other aspects of the reporting entities, results, position, cash flows, whatever it might be, just from rearranging the numbers measured and recognized in the same way as is currently required in the existing standards. And I will also encourage you to participate in the debate. We have a final slide that it would be good to see. There is an email address to the NRS that you can use to provide some information and points of view to us that we will consider for our response. And there is also a link there to the EFRAG website where you can both volunteer for the field test and also express your views to the EFRAG comment process. So with that, I actually think that we've reached the end of this webinar. So I will close off then. Thank you very much for your participation. Goodbye.
Thank you, everyone.
Thank you.
Thank you.
Thank you.
And goodbye.